Hey everyone, I'm here with Jack. He's the head of regulatory relations at Electric Wind Company, Zcash. He'll be doing a talk on when legacy financial regulation and zero knowledge proofs collide. Once he starts talking, can you guys confirm in the chat that you can hear him?
Okay, I'll get started and I'll keep an eye out for. We can't hear him in the chat. Um, so, as mentioned, I work with the Electric Coin Company, which most of you will be more familiar with as the team behind the Zcash cryptocurrency. Zcash has been around now for nearly 4 years. It's has privacy preserving features in the sense that it gives users the options of uh, of transacting privately. And here you can see that people can transact transparently, which is very similar to Bitcoin, or they can use shielded transactions to transact privately. It's widely adopted and supported cryptocurrency. Big exchanges like Coinbase, Gemini, all support us. And we're ranked about 25th, 28th in terms of market capitalization. And yeah, but we kind of a punch above our weight in terms of transaction volume and trading volume and so on. But one of the key, differentiating features here is obviously the privacy aspect, and that's something that we do because we believe that financial privacy is important. We think that if cryptocurrencies become mainstream and get adopted by everybody, that they're going to need privacy preserving features. And governments agree with this. In the US law, there is a policy that financial institutions should protect the financial privacy of their customers. And very recently, the chairman of the Federal Reserve was speaking before the House Financial Services Committee, and he gave the opinion that the idea of having a distributed ledger for a central bank digital currency where everybody could see every single transaction that was happening didn't seem to be something that was compatible with the sort of United States way of doing things. Now, if you think about traditional financial networks, if we need to send money to somebody else and we're unable to simply hand them cash, then we go to a bank, we ask the bank to send the money to that person's bank, and then they can get the money from that person's bank. So here, the burden of privacy falls on the bank, and there are laws that mandate that banks protect their consumers' privacy. These banks typically operate in a traditional financial system. There's generally a central bank system at the center of it, and that's how money gets transferred from bank to bank. And we all use these banks. But one of the key things about this type of structure is that there's this concept of a regulatory perimeter that goes around the banks in this picture. Here's the blue line. And what this means is that everything inside that blue bubble is regulated in some way. Outside it, if people want to hand cash to one another, or if somebody wants to hand cash to a shop or transact, in a personal fashion, that's not something that's regulated apart from just normal laws that prohibit things like drug dealing, ransom attacks, and so on. But everything inside this blue bubble is regulated. And there's various types of regulation. We have consumer protection, so making sure that the bank doesn't end up going bust and losing all its depositors' money. As I said before, there's financial privacy and confidentiality so that they don't leak details of your financial transactions to the world. There's rules around systemic risk reduction to prevent problems like we had during the financial crisis in 2008. And then there's the prevention of money laundering and terrorist financing. And there's a whole suite of approaches to help prevent those things. The key one is know your customers, so that banks are prohibited from doing business with people who they aren't able to identify. They monitor the transactions that those people carry out to make sure that the pattern of transactions, the amount that's being transacted, the volume, the destination and sources of payments all match the profile that they've created of that customer. And so for example, let's say a high school teacher in New Jersey signs up for an account with a bank, but then starts sending large amounts of money to somewhere overseas, and they're logging into the online banking from an address in, I don't know, the Middle East, then that would cause warning flags to go off. And that's what transaction monitoring is. If they see suspicious activity, banks are required to make suspicious activity reports, and they also make currency transaction reports above certain thresholds. And there's this thing called the travel rule, which means that every or most transactions between financial institutions must carry with them the name and the identity of the originator and the beneficiary of the transaction. And then with all of this, records must be kept so that if law enforcement need to investigate, they have access to the records of these financial institutions, who are then required to, per court order or warrants or whatnot, to share them with law enforcement. Now, in the United States, the AML and terrorist financing regulation is enforced by Financial Crimes Enforcement Network, and globally, there's an organization called FATF, which is an intergovernmental organization which makes sure that there are standards across the globe so that you don't get countries where the AML CFT requirements are more lax or easier for criminals to exploit. I'll come back to FATF in a while because they play a key role in what I'm talking about. So with peer-to-peer financial networks, of course, if Alice is sending Bob some cryptocurrency, it doesn't involve a traditional financial institution. But in practice, it usually does, because usually Alice will have obtained her cryptocurrency via an exchange and will probably have bought it using dollars that were transferred to that exchange through the traditional financial system. Now, back in 2013, FinCEN decided that cryptocurrency exchanges were to be classified as money services businesses, which brings them under that umbrella of regulation for prevention of money laundering, terrorist financing. So here we have the blue box. It encompasses Coinbase and the bank, but still the individuals are still not subject to regulation. Now, if Bob wants to sell his coins back to dollars at the far end, he will probably do so by going again through a cryptocurrency exchange where he has to undergo KYC and then receiving those dollars via a bank. And all of this means that there's visibility of transactions that are taking place between individuals and the cryptocurrency exchanges, but not necessarily between individuals themselves. Although there are companies that now offer blockchain analytics solutions to be able to trace the source or follow funds to their destination. Now, this area at the bottom, which isn't subject to regulation but can be subject to surveillance if there are no privacy-preserving features on the cryptocurrency, is often referred to by regulators as unhosted or non-custodial wallets, and it's recognized as falling outside of the regulatory perimeter. Now, all these regulators have obviously paid a lot of attention to cryptocurrencies. There's been a lot of alarm and speculation about their use by criminal gangs for the financing of terrorism. And about a year and a half ago, FATF, this global intergovernment agency, which at the time was chaired by the United States delegation, they introduced a set of rules to apply anti-money laundering and counterterrorism financing rules to virtual assets, cryptocurrencies, and virtual asset service providers, exchanges, custodians, the sort of companies that interact with and provide services that relate to cryptocurrencies. Now, back then, they applied a set of rules that were very, very similar to the sort of rules that apply to banks. They included the travel rule within them. So if a virtual asset service provider, if an exchange sends some cryptocurrency to someone else on your behalf, then the virtual asset service provider has to include information about the originator, your identity, and the identity of the recipient. So those records are kept so that the recipient exchange can make sure that the person to whom the address that the funds are being sent to is controlled by is actually the same person that's in the information defined as the recipient. So that caused a little bit of consternation because, for example, if I go to a cryptocurrency exchange and I tell them that I want to withdraw funds to a specific address, there's no way for them to know whether that address belongs to another exchange or a custodian or someone to whom they have to send this information. So there's been a bit of work to try and figure out how to be compliant with that. And I think this is a symptom of a situation where regulators are approaching an area where there's brand new technology. This whole concept of peer-to-peer finance isn't something that they've dealt with before. And they're looking to apply the same rules or the same solutions that applied to the old financial system. They're used to the system where you have banks and financial institutions, money services businesses acting as gatekeepers and keeping records of all the transactions that take place. And obviously, while we still have the ability to carry out cash transactions by simply handing $20 notes to one another, the size and scale of the transactions that take place there are of a specific nature. Number one, just simple logistics means that it's difficult to transfer very large amounts of cash around that way, and it's also very difficult to transfer them internationally. Unless you're going to start shipping pallets of cash around, you normally have to go through the traditional financial services system. And these KYC, these suspicious transaction monitoring, all of these serve to put barriers in the place of those who would try to exploit the traditional financial system to launder the proceeds of crime or to carry out the funding for terrorist attacks. But this new concept of peer-to-peer transactions, the ability to transfer money around the world in a permissionless, borderless, instant fashion without having to go and get someone's permission is something new. And I think that they're still struggling a little bit with the concepts, and also probably struggling with where the balance is to be struck between regulating this area and permitting it to grow and develop and innovate in a way that's going to benefit society at large. I've left this up on the screen to give you a few minutes to read it. So, like I said, 18 months ago, FATF came out with these recommendations, and then after 12 months, so a few months ago, they decided to review it and see what the progress was. And one of the things that they noted was that there was this big risk around virtual assets where there could be peer-to-peer transactions, which is, of course, the primary purpose of cryptocurrencies. Now, they've suggested here, as you can see, that this may pose risks, and that one of the things that could be done to mitigate these risks is to ban or deny licensing of platforms, by which they mean exchanges, if they allow unhosted wallet transfers. So what they're suggesting here is that whereas today you can withdraw cryptocurrencies from an exchange like Coinbase or Gemini and hold them on your own personal wallet, on your phone or on your Trezor or on your Ledger, whatever you decide to use, whatever wallet you decide to use. In the future, if this were to come to pass, that would not be permitted. The regulators would require that exchanges not allow withdrawals or deposits from what they call unhosted wallets, i.e. personal wallets. And the idea seems to be that there would be a kind of a walled off garden within which all cryptocurrency would take place between financial institutions. And if you wanted to send funds to someone else, then you would have to go to your cryptocurrency service provider and send the funds to the recipient's cryptocurrency service provider. Now, you may notice that this looks very, very similar to the traditional financial system, just with an extra layer on top. So I just wanted to, explain that or highlight the fact that, whilst we have taken great strides in adding privacy-preserving features to cryptocurrency, I think, Zcash represents one of the most innovative and advanced mechanisms for doing that. There is a risk that regulators who are trying to grapple with this real problem of money laundering and terrorist financing could end up introducing rules that will actually stifle innovation and prevent us from being able to use cryptocurrency the way that we enjoy it today. Now, there's a real use case for cryptocurrencies for being able to provide access to people who are unable to access traditional financial services. And here's a great example from just a few days ago of where the United States is actually releasing funds to the Venezuelan opposition to allow them to pay health workers in Venezuela. And the plan that they were going to use to distribute those funds to these health workers was to use a cryptocurrency payments provider called RTM, which some of you may be familiar with. Now, the Venezuelan government has reacted by shutting off access to RTM. So when you ask yourself, what sort of government, what sort of regime would seek to shut down peer-to-peer payments like this, here's your answer. It's an authoritarian regime that, most democratic countries in the world have got a pretty dim view of. So this is the risk that might happen, that might come about. What can we all do about it? Well, the first thing I would suggest is to support exchanges that support privacy-preserving cryptocurrencies. These are the ones that, for example, the Zcash. One of the great advocates for privacy and for sensible regulation of cryptocurrency and related businesses is Coin Center, which is a nonprofit based in Washington, D.C. And they do a really good job of educating policymakers, educating people on the Hill, making sure that they're aware of how cryptocurrency works and what the implications are of various potential approaches to regulating it. So I'd strongly encourage people to donate to Coin Center because they do really, really good work. And without them, I think we'd already be in a far worse position. And then finally, I recommend that no matter where you live, whether it's in the United States, whether it's in Europe or anywhere else around the world, the FATF is an intergovernmental organization. So every single country pretty much has got representatives there, and they all contribute to these discussions around what their policies should be. So I would encourage you to write to whoever your local representative is, explain to them that these policies risk denying cryptocurrency users the option of transacting privately, and it also often helps to highlight that most governments have enacted legislation to protect privacy, whether it's the Gramm-Leach-Bliley Act in the United States, GDPR in the EU, and most jurisdictions have similar legislation. There's a real risk as well that by shutting down cryptocurrency, by preventing its use by normal people, it will simply shut down the industry altogether, and that is effectively going to be stifling innovation. And it's going to really prevent in advance any potential for cryptocurrency to be used to help realize many of the benefits that we hope it will bring to the world, including expanding access to financial services. So thank you for your time. Thank you for listening. I just wanted to make people aware that this is going on, that these discussions are happening. It's a pretty dry and boring area, regulation to most people, but in this case, I think anybody who's at this conference, who's listening to this talk after the fact, I'm sure you'll appreciate that it has the potential to really impact our lives, our sector, and the way that we do business in a major way. So with that, I'll throw it open to any questions. So I don't know how do they come up in the chat, or is there a separate system for asking questions? If anybody wants to ask anything, just type it there in the chat because I can see the chat. If not, I might hand back some time to allow the conference to progress. How do we comply with the travel rule? So there's a few different ways of answering that question. With Zcash, it's really simple. If you are sending a shielded Zcash transaction, there is an encrypted memo field that gets attached to the transaction. And that allows you to send the travel rule information along with the transaction. The reason it's called the travel rule is because originally, when it, as it applies to bank transfers, the information is meant to travel along with the transaction. So with Zcash, you can do exactly that. Now, with other cryptocurrencies, they don't have that feature. So cryptocurrencies like Bitcoin, for example, don't have an encrypted memo field. You can't attach information to a transaction. So there are various organizations and groups out there that are working on solutions to this. They're looking at, for example, establishing a directory of virtual asset service providers so that if a VASP is sending a transaction, they can check the directory, ask the members of the directory if they own the address to which the transaction is being sent to, and if so, then they'll know where to send the information. Or they may simply ask the sending customer if the recipient is a VASP. But it's still very much at these solutions are being designed, they're being worked on, but there's been no real implementation of a decentralized solution yet. There are some commercial solutions which obviously bring their own disadvantages, but by and large, it's still very much an emerging area. But we like to say that Zcash is one of the only cryptocurrencies where you can be compliant with the travel rule. What do you feel is the future for innovation in the US for the coming 5 years? There's this interesting trend emerging at the moment in the United States. It happened before during the 90s, where there's this skepticism or fear around potential misuse of cryptography. Now, back in the 90s, it was referred to as the crypto wars. The US government effectively placed restrictions on the export of cryptography. And the reason that they did that, because they feared that it would be used by criminals, by terrorists, by foreign powers to shield their communications from the authorities, from law enforcement, and from intelligence services. Now we fast forward, 20, 25 years, and we're facing a similar situation with what's referred to as end-to-end encryption on communications on things like WhatsApp and Facebook, and also looking at cryptocurrency. So there's communication where you can talk to one another, and then cryptocurrency allows you to send money to one another, all without going through a central counterparty, i.e. that centralized financial system, and all without having to ask anybody's permission, which means that it's difficult to control it. So there's this. It feels like a generational thing where the last time round there was this fear, and there was an attempt to exert control over the export of cryptography back then, the adoption of cryptography. That the industry and commercial interest basically said, well, hang on, if we can't transact privately, if we can't protect ourselves from the hackers and criminals on the internet, then we're not going to realize the potential of this thing called the internet, which back in the mid-90s was still pretty new. So those people effectively won that argument, though the restrictions were largely lifted, and we have the internet as we have it today, where most of our interactions that might be sensitive. So if you're logging onto your banking website, if you're making a card payment, those interactions are all protected by SSL, TLS style encryption. And we've now got widespread adoption of end-to-end encryption for chat systems, so your Telegram, your WhatsApp, Wicker, and so on. And similarly, cryptography is being used for transferring value in the form of cryptocurrencies. I suspect that we're going to face a similar battle. I think the lines are already being drawn where various members of those who walk the corridors of power are looking at these things. They're seeing the potential for misuse, but they're failing to weigh it against the potential benefit. And that's where the real decision needs to be made. And I think that we do run, back in the 90s, there was a period during which were real restrictions placed on cryptographic software, which caused a lot of difficulty and hassle and overhead for people, and did, I think, reduce the security of people who were genuine law-abiding users. And I think that we're going to see the same thing if we are not successful in getting in front of this thing now. And that's why I chose the topic and laid out this challenge that we're facing for this conference, because although these decisions seem to be far away, they seem to be distant, they seem to be taking place in our nation's capital or in other nations' capitals around the world, they do have a real impact upon us all. And I think that we all have the ability to have an impact upon those decisions, because while our individual voices are small, if lots of people start writing to their representatives, start raising this, start questioning why this is happening, and start pointing out some of the facts that while there is some usage of cryptocurrencies for illicit and criminal uses, it's nowhere near the scale that the traditional financial system suffers, and that there appears to be a risk here that innovation and the protection of innocent people will be stifled, will be prevented. So I think that you know innovation always requires freedom, always requires um, the ability to do things differently. That's really what the definition of innovation is. So if we start over-regulating technology and we start introducing a whole bunch of different rules, and that can be either explicit rules that prohibit certain things, or it can be rules that mean that technology companies start being held responsible for anything that's done with their technology, then we really stand the risk that people will just not feel safe to innovate anymore. The risk of adverse consequences of innovation will outweigh the likely benefits, and that risks creating a situation where a lot of activity could be driven underground, where simply the end users don't get to realize the benefits of innovation that just doesn't take place. So I don't see any more questions there, and we're getting close to the bottom of the hour. So I think I will. Let's see. Um, why do you say that Zcash is one of the better choices versus another privacy coin? So there are different approaches to privacy, and the one of the key metrics for understanding how good the privacy of a cryptocurrency is what's called the anonymity set. And with Zcash, your anonymity set is every single transaction or every single shielded transaction that has taken place in the past. And that's why we feel that the privacy that's offered by Zcash is amongst the best. That's not to say that other approaches aren't good, just that we feel that by that metric, it's probably the best.
Thanks, Jack. This was a really great talk. We're going to transition to our next session now.
Okay, thanks very much for having me.
Yeah, thanks again.